Welcome everyone on this specific webinar that we have on exchange traded funds as ETFs, the new investment frontier. So the structure of the webinar is going to be that I'll be talking about ETFs, the next frontier, and then I'll be talking about the structure of ETFs, that is exchange traded funds. Then what are the advantages of ETFs? Then comparison of ETFs with mutual funds, how ETFs compare against mutual funds, and most important, what is the future of ETFs in India, where we are today, and what's the future of ETFs going forward. So first of all, looking at ETFs, that is the next frontier. What we see is that this is one of the newest investment opportunities for India. India got its first ETF, that was Nifty Bees, in 2001, which was launched by a company called Benchmark AMC, which again they sold it off to Goldman Sachs in 2011. And later Reliance Nippon bought most of Goldman Sachs schemes. So at that point of time, when Benchmark AMC managed ETFs in 2004, the total fund that was managed was close to only 70 crores. But today, the size of the Indian ETF market has grown to 65,000 plus crores. So what we can see is that there has been a spectacular growth in terms of the funds that have come under ETF. So from 70 crores in 2004, today it's at 65,000 crores plus 65,000 crores. And globally, if we look at ETFs, the first modern day ETF, there's a nickname called Spiders which is used for that, and that is S&P SPDR. That was launched in the US in 1993. So it basically tracks the S&P 500 index. So the US S&P 500 index, that is the underline for this specific ETF, which was the first modern day ETF launched in the US in 1993. And the first ETF that came into India was in 2001. Today, there are almost 2,000 ETFs listed in the US. So you can just imagine the growth that has happened in the US markets in terms of ETFs. And if you look at the total money that is managed globally through ETFs, that is mind-boggling. That is almost close to 4 trillion US dollars. So that's a huge amount of money which is moved into ETFs over the last, I would say, 10 to 15 years in particular. So clearly shows that why it's called the next frontier. I will explain that as well. So we will now look at the structure of ETFs. What are ETFs? What are their features? And how do they stand out? Then we'll look at some of the popular ETFs that are traded in the domestic markets. And also I'll be telling you where you can get information on ETFs as well. So exchange traded funds are basically they're also essentially index funds that are baskets of stocks that reflect the composition of an index. So for example, you have the S&P CNX Nifty 50. So you could have an ETF which is benchmarked or against the Nifty 50. So the ETF would perform as per the Nifty. And second is that this exchange traded funds or ETFs, these are listed and traded on exchanges like stocks. So you can buy anytime, you can sell anytime on a real-time basis. So that's a major advantage of ETFs. And also it enables investors to gain broad exposure to entire stock market with ease. So for example, if you are bullish on the broad-based say Nifty, and you want to invest. So there are various, you can go in for futures, you can buy a Nifty future, or you can buy a option. But you have to remember that those are leverage instruments, and also they have expiry dates. So again, after towards close to expiry, you will have to roll over your position. So ideally, futures and options, they are more suited for traders or those who want to hedge their positions from a short-term perspective. But for those who are looking at a long-term perspective and also who want to stay invested, ETFs is a very good opportunity for them. so you can invest and stay invested. And also the cost is lower than that is the transaction cost is lower than many other forms of investing. That's one major benefit of ETF. And also its traded value is based on the net asset value of the underlying stocks. So the net asset value of the ETF is determined by the underlying value of the stocks. And you can either purchase the ETF on the exchange or directly with the fund that is managing the ETF. And apart from that, ETFs, that is, they trade close to the NAV. So you'll find that ETFs are trading close to the NAV due to transparent portfolio holding and predefined creation basket. So what it means is transparent portfolio holding. So you know so you exactly know once you're getting into buying an ETF, that which are the stocks which are going to be there in that particular ETF. Because if an ETF is mirroring the Nifty index, then it will have all the stocks in similar proportions in its ETF and predefined creation basket. So because that's all predefined. And the best part is that it is suitable for retail as well as institutional alike. So for retail as well as for institutional, it makes a lot of sense going through ETFs. And ETFs units are continuously created and redeemed based on investor demand. So it's not only the primary, the secondary market where you can buy and sell. It's also the primary market. So you can buy it from the fund as well. So ETF units are continuously created and redeemed based on investor demand. So these were some of the major features of ETFs, and we'll talk about few of the ETFs that are traded on, say, for example, NSE. We have ETFs in equities, we have in debt, we have in gold, and we have in international indices. So we'll look at them in brief, so you will get a better idea. Now, first we look at the equity ETFs. So if you're looking at buying an ETF with an underlying Nifty 50, so in that case, there are different financial institutions which have their ETFs like UTI, Edelweiss, ICICI Prudential, Kotak, Motilal, Quantum, Religare, SBI, Birla Sun Life. So apart from that, there are other companies also which run the ETFs with the underlying Nifty 50. So if you're bullish on the Nifty, you can buy an ETF. You can buy into an ETF and you can hold on to for as long as you wish. So you can get that advantage. Then apart from that, Nifty 50, you have other equity indices, other equity ETFs such as the Nifty Bank, such as the Nifty Mid Cap 100. So say for example, you feel that the mid cap sector is likely to perform better. So in that case, you can invest in a Nifty Mid Cap 100 ETF. Apart from that, you have, if you just want to invest only in public sector banks, so you can then stay invested in the Nifty PSU Bank. Or if you want both the public and the private, then the Nifty Bank can be, there are ETFs based on the Nifty Bank as the underlying. Then you have ETFs like Nifty India Consumption, which is more or less those companies which are into the consumption space. So they are there. So you, rather than buying those individual companies one by one, you can buy this ETF, which has the Nifty India Consumption Index as its underlying. So I think you would be clear now that ETFs are a very good investment vehicle, as well as from a short-term trading perspective also they can be well used, because you can buy and sell real-time basis, and also the costs are very low because they are traded on the exchanges, so the costs are comparatively very low. Recently, you would remember that there was this S&P BSC Bharat 22 ETF that was launched. So this ETF basically tracks the 22 stocks of central public sector enterprises, public sector banks, and strategic holdings of SUTI, that is a specified undertaking of the Unit Trust of India. So what basically this ETF does, that Bharat 22 does, is that it has got, it basically, this index tracks the performance of the 22 stocks which are central public sector enterprises, public sector banks, or strategic holdings of SUTE, that is a specified undertaking of the Unit Trust of India. And like you have the stocks like the likes of SBI, IOC, NALCO, ONGC, BPCL, NTPC, Bank of Baroda, IPC, Larsen and Toubro, Axis Bank. So you have got all these stocks which are there in this ETF. So rather than going and buying a specific stock, you can buy this ETF itself, which will have an exposure to all these stocks. So if these stocks perform well, your ETF performs well, and these are generally the blue chip companies. And yeah, there are again rules for this, that a weightage is capped for each stock at 15% of the overall weightage, and sector wise it is at 20%. So a stock can maximum have a weightage of 15%, and if there is another stock in the same sector, then that stock cannot have 15%, it can maximum have 5%. So what it effectively means is that the sector cap is fixed at 20%, the stock cap is fixed at 15%. So this basically helps you diversify. So if you're looking at this Bharat 22 ETF, what you see is that you've got SBI, you've got Bank of Baroda on the public sector bank, you've got Axis Bank on the private sector bank, you have got ONGC, IOC, BPCL on the oil and gas, you've got NTPC on the power, you've got NALCO on the metal side, you've got ITC, then you ITC on the FMCG side, you got LNT. So you can see for yourself that you have a diversified portfolio, and the best part is that you buy into this Bharat 22 ETF, and you can stay invested for as long as you want, and you can sell whenever you want on the exchange itself. So it's just like trading the way you trade stocks. So I earlier talked about like equity ETFs. Likewise, we have ETFs in gold as well. We have and they are traded on NSE, so you can trade on NSE. You have to have your account, and you can buy and sell these ETFs. So gold ETFs, these are basically passive. What you need to understand here is that ETFs are more passive in instruments wherein you buy and you hold for a long-term period of time, but that is not necessary. You can also buy, and if you're making good returns, you can exit as and when you wish, because it's on a real-time basis. So that is the major advantage. Apart from that, if you look at gold ETFs, these have gold as the underlying, and basically these ETFs, they invest in gold bullion. So the price actually mirrors the gold prices. So that's a major advantage. So if you don't want to buy physical gold, then because if you're buying physical gold and if you're buying in the form of jewelry or ornamentation, so you have the making charges that you pay. Secondly, if you buy physical gold, then storage and keeping is a issue. So why do you need to buy gold? And generally, it's been said that if you are investing, say for example, 100 rupees, then around 10% of that should be in gold. So roughly 10% of your total investment purpose should be in gold. So rather than buying physical gold, you can buy gold through, you can stay invested in gold ETFs on the exchange. So you've got like Reliance is there, Kotak, SBI, UTI, HDFC. These are few of these companies which have their gold ETFs. So you have that advantage. And also the ETFs have much lower expenses as compared to the physical gold investments, as I said, because of its unique structure and creation mechanism. So there are significant advantages if you get into in ETFs. And also the best part is if you're wanting to hold from a long-term perspective, you want to invest in gold, you feel that gold is likely to go up, then you can ETFs are a very good way. The costs are definitely far cheaper when compared to other avenues of investing. Apart from the equities and gold, we also have debt ETFs. They are again traded on NSE. They allow investors to take exposure to fixed income securities, and they basically combine the benefits of debt instruments with the flexibility of stock simplicity investment and simplicity of mutual funds. So basically you have ETFs in debt also on NSE, so you can invest in them. Apart from that, you have world indices ETFs. So world indices ETFs are also available. There is a Motilal Oswal ETF on Nasdaq 100. So you can invest in that from a long-term perspective. These are global equity exchange traded funds. These allow investors to take exposure to international indices. So you can take exposure to international indices. So as I said, you have the Nasdaq 100 by Motilal Oswal. So that's one ETF that's on NSE. So you can invest in this. So basically, what I want to tell is that ETFs are a very good opportunity for investing, for diversification, for bringing down your costs of investing, and for holding from a long-term perspective, while at the same time, if you are making decent money, you can exit from a short-term perspective also. And because the entry and exit can be on a real-time basis, because you can trade them just like as you trade stocks. So those are the major advantages of ETFs. Now the big question is, where do you get all these details if you really want to go ahead? So on nseindia.com website, if you go, you can get all the ETFs. On the right hand side, you see this chart which is there, which I have put up. That's from NSE India. So you get to see which are the ETFs. You click on them, you get to see the performance of the ETFs. You get information on the ETFs. And on the right hand side, you have this from the money control, wherein you have performance of ETFs. So on the money control, under the MF section, you have the ETFs section. So you can look at the ETFs, you can see the performance. You can also see what is the AUM, that is the asset under management, asset size, how the returns have performed over the last 1 year, 1 month to like to 3 years or so, how they have performed. So you can get all that details. So that's the reason I have put up this slide, so as to help you. Coming to the next point is the advantages of ETFs. Some of them I've already covered, but I'll again talk about the main areas. One is that ETFs allow long-term investors to diversify their portfolio at one shot, at low cost, and insulate them from short-term trading activity. So if you're a long-term investor and you want to diversify your portfolio, Bharat 22 can be a very good. If you're bullish on the equities market, you can invest in Nifty 50, means ETFs which have the underlying as Nifty 50, or if you want, you can invest in if you want to go for a specific sector, it could be the bank. If you're looking at the banking, it could be in the bank Nifty. So the index, which is the ETFs which have Bank Nifty as the underlying. So you've got all these ETFs which are there. So if you want to invest in gold, you have your gold ETFs. So the point what I'm trying to say is that they can help you invest from a long-term perspective. They can help you diversify. Your strategic diversification of your portfolio is possible, and the cost is comparatively very low. And it also helps you prevent short-term trading activity. So if you want to trade from a short-term perspective, then you can definitely trade ETFs, but you can also trade stocks, or you can trade futures and options depending upon your risk appetite, your knowledge, and your time frame. So apart from this, you have the advantages of ETF is that it provides liquidity for investors with a short-term horizon, as they can trade intraday and they can have quotes near NAV during the course of the day. So because they can be bought and sold like any stock on the exchange at a real-time basis, so you can also trade this ETF from a short-term perspective. And the minimum investment is 1 unit. So ideally, you can invest a very small amount. Just you can say even invest 5,000, and you can have stay invested in an ETF. But then the best part is that you enjoy the flexibility of a stock and diversification of an index fund. So flexibility of a stock means you can buy anytime, you can sell anytime, and you can see there is complete transparency. So you get to see the NAV on a real-time basis. You get to see the NAV, and also the diversification of an index fund, because it has got so many stocks which are there. So you see how they overall perform, and that basically is the return of the index, which the ETF mirrors. Then apart from that, most ETFs have lower costs than other equity funds, because of the passive nature of the funds and the fact that the structure closely follows an index. So the cost can vary 0.5% to 1%. It could be even lower. So the costs are comparatively low for ETFs. So you should definitely explore this area if you have not done yet, because it's a very, I would say it's an excellent area for long-term investing. It also gives you the opportunity of diversification. It also helps you invest a small amount of money and spread it across. And the best part is it's real time, so you can enter and exit as you wish. So that's a major advantage. So now we shall look at the comparison of ETFs with mutual funds. We look at how ETFs compare against mutual funds. So first of all, we look at there are different parameters. So we look at the different parameters. The first is the fund size. So we've looked at the open-ended fund, the closed-ended fund, and the exchange-traded fund. So there, the fund size is in the open-ended, it is fixed. In the closed-ended, again, in the open-ended, it is flexible. In the closed-ended fund, it is fixed. And again, in the exchange-traded fund, it is flexible. because you can buy the ETF units from the fund itself. Then the NAV, if you see, for an open-ended fund and a closed-ended fund, the NAV is on a daily basis. But on an exchange-traded fund, it is real-time basis. So that's a major advantage. Thirdly, if you look at the liquidity provider, who's providing the liquidity? So you have in open-ended, you have the fund itself. In closed-ended fund, you have the stock market. Whereas on ETFs, it is the stock market as well as the fund itself. So you see that advantage is also there. Now look at the sale price. So if you look at the sale price, for an open-ended fund, it is very close to the NAV plus the load, if there is any. For a closed-ended fund, you see a significant premium or a discount to the NAV. But in an exchange-traded fund, if you want to sell, it's very close to the actual NAV of the scheme. So that's again one major advantage. Availability, open-ended fund through the fund itself, closed-ended fund through the exchange where it is listed, and ETFs both on the exchange where it is listed as well as the fund itself. Portfolio disclosure for an open-ended and closed-ended, you have the monthly disclosure. On an exchange-traded fund, it's a daily or real-time, because for the simple reason is that the underlying is known very well. Then what are the uses? You have equitizing cash. So open-ended fund, basically you can invest your money in that fund. If you look at closed-ended fund, here again you can definitely, but once it's closed, then you can't enter that fund till again. As far as exchange-traded funds, you have equitizing cash, so you can invest anytime that you want. You also have hedging and arbitrage opportunities through exchange-traded funds, so you have that advantage. Next is intraday trading. Open-ended fund not possible. Closed-ended fund, it's very expensive, and exchange-traded funds possible at low cost. So you can buy and sell ETFs intraday, real time at a low cost. So that's one perspective you should definitely look at as well. So now we look at the future of ETFs in India. This is something which is of, I would say, of significant interest. Popularity of ETFs is growing due to government's plan to divest its holding in PSUs. There was this first divestment that was through CPSC, this ETF, which mopped up 11,500 crores. Apart from that, we had the Bharat 22 ETF, which mopped up 14,000 crores against expectations of 8,000 crores. So what we are seeing is that there is a renewed interest in ETFs in India, and also, as I said, current market size of the ETFs is the holdings is close to 65,000 crores, which was in 2004. If you look at that, was close to 70 crores. So we've seen a significant increase, and also if you look at the employee provident funds organizations, that is EPFOs, their investment in ETFs is expected to touch 45,000 crores by the end of this fiscal. Now, some very important information which will really, I would say, open your eyes on in terms of ETFs. If you look at the US markets, ETFs are close to $3.8 trillion. That's the amount of money that's moved into ETFs in the last 15 years in the US. And last year alone, in 2016, there was an infusion of $400 billion. That is close to 25 lakh crores in the US ETFs itself. So you can just imagine the level of popularity and the level of interest that is there in ETFs in the US. So if it is there in the US, someday the other it's going to happen in India as well. So you can be an early bird, and you can also look at this opportunity. And if you look at this particular table which is there, this is wherein you see that there are basically 10 different securities which are there in, you can see, blue color and orange color. So the point here is that among the 10 most actively traded securities in the US markets, 7 of them are ETFs. Only 3 are stocks. Rest all are ETFs. So now you can just imagine what is the level of popularity of ETFs in the US. In India, we are far away from that day, but just like you look at the mutual funds, the way the mutual funds have grown over the last few years, from initially it was a slow pace, and currently we are having close to 5,000, 6,000 crores entering on a monthly basis. So the point what I'm trying to say is that that flow will also start in ETFs someday or the other. So you can take advantage, you can learn, and you can invest, you can diversify, you can lower your costs. You have a real time window of investing and trading opportunity there. Your NAVs are transparent, real time available. So that's a major growth. And since we've seen this significant growth in the US and the developed markets, the same trends we'll also see in the Indian markets in terms of ETF. So you should definitely look at ETFs from an investing perspective, because ETFs are the future. So with this, I conclude my session on ETFs.